Hello everybody, Wesley here with MatherBrain.com. Super excited to be bringing you another video today. Today we are doing something a little different. We're going to be reviewing a stock. I guess I will be reviewing the stock. I have been researching this stock for about the past week and a half, reading lots. Before we go into it and tell you what, well I guess I can tell you what stock it is. It's RioCan. RioCan is Canada's largest REIT, and before I get into any numbers, I just wanted to tell you the resources I use to research stocks. And if you guys have any websites or any resources that you like to use, please leave it in the comments down below. I'd be interested, and I'm sure everyone else would. I always read through the financial statements. I print them off. I use Sedar.com. That is the official website for that stuff. I'll leave a link down to that below, but I printed this off. It's, I know, maybe 40 pages or so, double-sided. Really interesting, great information to read from that. I also use a web broker because I do use TD Web Broker, so they have a platform that I generally like. Some things I do like, some things I don't. And I also use Yahoo Finance to kind of complement TD Web Broker, as Yahoo Finance has some very wonderful stats and statistics that they have that TD Web Broker does not have. So let's jump right into it. I hope this video is not going to be too long, but to fully research and then explain my findings in a 4 to 8 minute video might be challenging, so please bear with me. All of this is very important when deciding if I should or if any of you should be investing in this stock. And of course, always do your own research. This is just my findings and my opinion. If you can't come to a decision of your own, please go see a professional. So first I want to start off with is that RioCan has a market cap of about $7.7 billion and a enterprise value of about $13.6 billion. With that market cap, that does make them the largest REIT in Canada. They trade around $25.36 a share, at least as of this morning. And they do have 304.6 million shares outstanding, which, if you don't know, the share price times the amount of shares outstanding does give you that market cap. They also pay quite a nice dividend at 5.0%. That is annually, obviously, their dividend yield, which turns out to be $1.44 a share, so that is quite nice. The industry average is only 5.06%, so they are above the industry average, which is always nice to see. But with dividends, you always need to be looking at the payout ratio. If they are paying out more than they are earning, which is never a good sign. So RioCan's payout ratio is 76.96%, and so that may seem really high for a stock if it's paying out 80% of its earnings, but it is a REIT. If it pays out a lot, it doesn't pay any income tax, which is great, so it can save money and do that for other items or for the dividends. Compared to the industry average of 47.24%, so it does pay above the industry average, but that payout ratio is sustainable, and you can look through the financial statements and see if it's paying out too much. If it is paying out too much, then why am I going to invest in that stock? I said there in my notes that it's not a red flag for me. As I explained, it's sustainable and it's a good dividend. It is higher than the industry average, and for investors like us, for shareholders, who doesn't love big dividends? It has a PE ratio of 13.74, so not bad at all for a REIT. It has a debt to capital of 43.98%. With REITs, this is another good metric to look at, because REITs tend to have a lot of debt. But with a lot of debt, that means that they can use that as leverage to help expand and to help grow. And so the payout ratio and the debt to capital is something I always look for, because with a REIT, you want it to be paying out a large dividend, but you want it to be sustainable, which in this case I believe it is. And with debt to capital, they can have a lot of debt from mortgages, or if they are financing through bonds, they can tend to have a lot of debt. But with that, it can help them grow, because with a REIT, if it doesn't buy more properties, it doesn't make any more money. And so that's no concern of mine at all. With all those metrics, RioCan does slightly fall behind in some other metrics compared to the industry average. It is above in the dividend yield, which is great, but the payout ratio is quite a bit higher. Debt to capital is a little bit higher than the average as well. The return on investment is 4.35%, sorry, and the industry average is 6.24, so a little less again. Same with the profit margin. The profit margin is 51.50%, and the industry average is 74.04%. So even though RioCan does kind of lag in some regards, it's a big, very well established REIT, obviously the largest in Canada, as I've said. So that doesn't really bother me with the ease of mind that I get from this, because of its steady, large earnings. With that less risk that I get because of that, I'm not worried about that. I wanted to add that it has 250 properties all over Canada, and those are retail focused with multi-use buildings, and I'll get into that a little bit later as well. Their recent income statement numbers, I just wanted to quickly share this with you because I found something really interesting, and always make a note of that either in the financial statements or on a notepad or whatever while you're researching a stock, because reading through 40 pages you can forget about things, but I made a note of this. So their income statement numbers, their 9 months ended September 30th, so the 9 months before that, leading up to the end of September 30th of 2018, their net income was $378 million. Yet if you look at the 9 months ended September 30th in 2017, so the same 9 months, just a different year, was $505 million. So quite a big difference from those two. And that's a big metric that I needed to find an answer. Like, why is the net income so much lower than it was the year before? And what I found is that in 2018, RioCan had sold all of its United States properties. Now there was quite a few. I believe there's 25 or 27 properties that it sold. Why would it sell all of these? It was worth $1.7 billion US dollars. Why would a company sell out all of its US holdings? Well, the reason is because RioCan wants to go and, I don't want to say define itself, but it wants to go into kind of a new market, and so it's selling all of its smaller, less developed properties and move into more, they say, they want properties with a lot more redevelopment possibilities, and they want larger multi-used facilities. So they sold out all of their United States properties, and they have sold some in Canada, but they have also been developing and purchasing new properties that fit into their new vision. And that explains why the 28 net income was lower than the 2017 net income. And doing your own research, you'll find that, and I wanted to point that out because it is important to find things like that and then find reasons as to why. Because if you can't find a reason to explain why, well, it could be, a shortage of customers, or maybe nobody wants to sign a lease with RioCan. And with this, they have a kind of a vision statement idea on their website. And so all of these new investments should help RioCan grow in the future. They said within the next coming decade, which I believe they said that in 2018, so a decade from 2018, which wasn't very far away, that all of these new properties and these new redevelopments that they're having should add nicely to their bottom line. And this hopefully also means a larger dividend as well, which is something always to look forward to for us investors. And as I said, all that selling caused some falling in earnings. This is just a short condensed version of what I found. That's all I'm going to share in this video. Please do your own research. I did want to end though with my opinion on this. I have probably researched this for 12 to maybe 24 hours in total, reading the financial statement several times, recent articles online and items from their website. And so I believe RioCan is a great buy for investors looking to build up their dividend portfolio. That is something I am definitely looking at. And it can also be a great way for people who want a bit less risk, because they are a big REIT and they have been quite a bit stagnant over the years. Now they have been paying out their dividend for the last 2 decades, but their stock price with capital gains hasn't moved a lot, and so that can be a good thing and a bad thing for a beginner investor like myself, and for probably many of you that could be a great sign, because then you won't have huge swings in that. But I do believe right now is a good time, at least within the next few months, is a good time to buy on RioCan stock because of these new plans that they are having with their company. And even though they may not excel in every metric, they are the largest REIT, and I believe that will help offset that. I want to thank you so much for watching this video. I put a lot of time and effort into this, so I hope you appreciate it. If you guys have done any research or heard anything about RioCan, please leave your opinions and your comments down below in the comment section. I'd love to read through them, see what you think about RioCan compared to what I think about. This is a group effort for myself learning how to be a better investor, and for all of you. Please also go to my website. That's at www.matterbrain.com. I will have a written version of this that should be up in the next few days. Go check that out. I have a bunch of other content on there as well. You can also follow my social medias on Instagram, Facebook, and Twitter. I'm trying to be a lot more active on those. I also have a newsletter. Make sure to go subscribe to that, as I email that out at least once a week. Again, thank you so much for watching. I appreciate it. I will see you next video.